So welcome back, everybody, to day number 2 with Amit Seru for the Princeton Lectures in Finance. Today, Amit will talk about modern financial intermediation, and he will explain how this modern financial intermediation goes beyond balance sheets. So we're very happy to have Amit with us again, like yesterday. Hi, Amit.
Hi, Markus.
So let me just give you the list again, who was the previous lectures we had here at Princeton for the Princeton Lectures in Finance. Last time we had Stefan Nagel, and his book is coming out in May on machine learning and asset pricing. And as I mentioned yesterday, we had all the big names in finance pretty much there, and Amit fits in line with that. And let me go to intermediation, a little bit on regulation. Amit will touch on regulation today. Let me just outline 2 views you might have. One view is that regulation is so good, it reduces overall risk. So essentially, risk in the system is less pronounced. Sometimes it might be too microprudentially focused, that the risk is too little for the overall economy the financial sector is taking on. Sometimes it might be excessive. But there's an alternative view, and the alternative view is essentially that, you know, regulation simply shifts risk around. It just is like a whack-a-mole game. You push risk down on one, but then it comes up in somewhere else. And you know, you have a certain parameter. Within the parameter, there's a regulatory framework. And if you're too tight, and if you make the regulation too tight, essentially risk is just moving outside the parameter, but it's not really disappearing. And how to avoid this and how to make the parameter larger and larger, that's typically what happens after each crisis. Is essentially you have a stick and a carrot approach. So on the one hand, you have a stick. If you're subject to regulation, that's a stick essentially the regulators imposes on the banking system or the shadow banking system, or more generally on any financial entity. But in order to ensure that you want to stay within this parameter, you also have to offer a carrot. And traditionally, this carrot was some monopoly rent to the financial sector. And this essentially makes sure that you want to be regulated. And we saw in the last crisis, in the global financial crisis, that many banks became bank holding companies in order to be regulated and be part of the protection of the Fed and the regulatory system. So there's always a stick and a carrot. But now with the global financial system, with fintech coming in, competition will be enhanced, which is a good thing, but also takes this monopoly rents away. And then also the tendency to go outside of the regulatory parameter is actually enhanced as well. And that makes the whole balance, to keep the balance inside the parameter more tricky. And that's what we have to think about. What's the optimal design going forward? Of course, importantly, when you have a setting with this monopoly rents, you also stifle innovation. So financial innovation, I think, is to a large extent a good aspect. We have to go with new technologies, and yesterday Amit was outlining a lot of new technologies which enhanced convenience for many participants and many customers. And you know, without competition, we won't get this enhanced innovation. And that's what we have seen yesterday. The innovation comes always from outside, from new entrants. It doesn't come from the existing banking system. Now let's talk to some poll questions which Amit will propose, and we'll come back to that. So the first question Amit proposed was, on average, what percentage of loans are originated by traditional banks that are kept on their balance sheets? What's the guess? And is it, you know, 90 to 100%? Only 6% thought that's the case. It's been 50 and 90%, 34% thought, or less than 50%. That's what the 60% were thinking. So less than 50%, the majority was thinking that. The second question was, the average capitalization of a traditional mortgage bank is about 11%. What do you think is the average capitalization of a shadow bank, which is also originating mortgages? It's been 5 and 10%. That's majority was thinking that. 55% were thinking this way. Is it between 10 and 20%? That's 15% of the participants were thinking this way, or above 20%. That's what 30% thought of the participants. And the final question is, if there's a drop in aggregate mortgage lending, if tier 1 capital requirements of traditional banks were increased, so by 50%, so I'm hiding that. So if you really increase the capital requirements, double, not double, but increase it by 50%, not percentage points, what do you think will be the implication in and 0 to 5% or less than 5%? That's what 20% think. half of the participants think it will be between 5 and 25%, or even more than 25%. That's what the 30% thought. So how much will be the drop in aggregate mortgage lending? So with these results from you participants, which we count on you to be with us, and it's very important to participate and ask questions, and I will pick up the questions again and throw them to Amit as we come along. And the floor is yours, Amit. So like yesterday, it's all yours, the floor, and we're looking forward to your presentation.
All right. Thanks, Markus. So let me start by where we ended yesterday. That's why there was the ... which Markus, you were asking about. So the title today is going to go from there and argue that when we think about modern financial intermediation, and this is both in terms of our thinking as academics and in terms of regulation, we got to think beyond how we have traditionally thought. And the traditional approach has been thinking about balance sheet banking, both in terms of thinking about risk and regulation. And I'll try to argue that that's not a very good way of thinking about where things are. And doing that will lead to probably unintended consequences in terms of what we wanted to sort of achieve. So this is, again, joint work with folks from yesterday, and also I'll add Erica Jiang, who's at USC, whose work is also going to be mentioned here. All right, so just as a reminder, yesterday we talked a lot about disruption happening on the asset side. I talked about on the lending, payments, wealth management, treasury and investment banking, a lot of fintechs and so-called shadow banks who are outside the purview of conventional regulation coming in and disrupting the activity that banks do on the asset side. Lots of common views on why this is the case. Lower cost, for example, or maybe they can do better risk assessment and that gives them an advantage over banks. And the point that I tried to make was that that's not necessarily all the reason why these intermediaries have expanded. A lot of this has to do with the fact that they are offering new products, and they're offering new products not cheaply, but at a fee because they are screening in consumers who have a high willingness to pay. And that's something that their technology allows them to do pretty nicely. And so you're not going to capture these in cost-based measures, or if you think about just credit risk. At the same time, I try to argue that there are limits to this technology. They don't seem to be going and helping the entire segment of the market, at least yet. They are, in fact, in parts of the market where you might think that their value might not be as high, at least when it comes to thinking about innovations like iBuyer and so on. So that was yesterday. Today, what I want to do is talk about the financing side of shadow banks, because doing that will allow us to integrate what we saw yesterday and today, because that has implications, like I started the talk with, in terms of how we want to think about what banks are doing and in terms of how we want to regulate them. So, the starting point is just the classic view out there, the balance sheet view, which says that, look, what are banks doing? They're taking deposits and then they're making loans, and they keep the loans on the balance sheet. They do a lot of screening and there's a lot of monitoring, and there is some value that's created there. If you think about regulation, it's pretty complex, but really it boils down to thinking about stability. How much stability do we want versus, well, providing too much stability might be coming in the way of maybe real economic activity. So we are trying to balance these two things all the time. So, for example, if you raise capital requirements, you're always talking about, hey, this leads to reduced bank lending, maybe higher rates and so on. And the starting point here is to say that the modern view of this bank is very different, because we already saw a substantial amount of activities happening right now in shadow banks who do not take deposits. In case you forgot, I just mentioned the consumer lending part of the market yesterday, and there, a substantial portion of activity is being done by shadow banks, almost half. If you look at this, what I showed you yesterday in the mortgage market itself, huge amount of penetration by shadow banks. Not all of them rely on technology. There is a big role technology has played, but a lot of role also because of regulation that banks were pushed against after the Great Recession. So a lot of activity is getting moderated here. We talked about that. So that's already telling you that just focusing on banks may be a little bit incomplete. But what makes it tricky is that if you look at where these shadow banks are entering, and this was something that I tried to mention yesterday, that the usual way of thinking that, okay, they are just going in one segment or the other is probably not right. And here is an example. Suppose you drill further down on where exactly did shadow banks get this market share. What you find is it's not homogeneous across categories. For those from the US, you know that when you think about the mortgage market, you think roughly about two parts of the market. One is the government control conforming market, and then there is a private market called the jumbo market. So what's being plotted here is bank market share. So that's the reverse of shadow bank share that I showed you earlier. And what you can see is that the decline of bank market share is not uniform here. It's way more in the conforming market. This is the market where government-sponsored entities, Freddie and Fannie, operate quite a bit. They buy in this market. The jumbo market used to be active before the financial crisis of 2007, but after that has been basically relegated to bank balance sheet market. So not uniform. You might say that, well, this looks like a time series trend. Do we really know that this is happening? And the big advantage of mortgage data is that it allows you to see a lot more detail than in many other places. So we can drill down. Here is a picture where you do that. So on the x-axis, what you're plotting is around the conforming jumbo threshold. Why is there threshold like this? Because conforming loans are typically smaller loans and jumbo loans are typically larger loans. So anything above 1 is jumbo market, anything below 1 is the conforming market. And what you see is that the bank market share is substantially higher in the jumbo market than in the conforming market, which is what I showed you in the time series as well. That's where banks have lost out. What is interesting is that if you think about what are the characteristics of these two segments, the jumbo market is harder to securitize right now, and the conforming market is easier to securitize because the government-sponsored entities are operating in this market. So you can originate and sell. Whereas in the jumbo market, you got to keep it on the balance sheet, which is where banks seem to have a lot of comparative advantage because they have a larger market share. And you can see that in the right picture, because if you see only on banks, how much are they retaining on the balance sheet? What you see is that, yeah, on the jumbo side, they are retaining a lot more than they retain on the conforming side. So there's an interaction between what's moving to shadow banks and what is happening in terms of retention versus selling that banks are doing. And one can drill down to that and ask the question that, okay, shadow banks are doing a lot of activity, but we obviously also need to understand better what is the bank's choice of business model and how that interacts with where shadow banks are competing with us or not competing with us if we are banks. And we've sort of done that. And if you take this data further and ask the question, okay, what are banks doing in terms of the loans over time? What this plots is what they sort of do with these loans. And the retained part is the bottom portion. And what you see is that this portion is not zero, but this portion is not very high either. It's not like in the poll question I asked, is this 90 to 100% or 50 to 90%? And it's not. And this is a trend, by the way, which is not just in the mortgage market. If you look at this across markets, auto market, corporate loan market, this is a trend that's been happening over the last decade or so, where banks are now retaining less and less and less. In the case of mortgages, which is being plotted here, they're selling to government-sponsored entities, but in other markets, they're selling to other entities as well. What is interesting here is that, yeah, they're selling and they're retaining, but is it uniform across banks? And the answer is no, because if you look in the cross-section, it turns out that the banks who have a substantial balance sheet capacity tend to be retaining more versus otherwise. And you can sort of see that in the data, both on the left, which is across lenders, and on the right, which is within lenders. And what's being plotted is you can look at the capital ratio on the x-axis, and on the y-axis is how much loans are they keeping on the balance sheet. And the idea here is just that, hey, as your capitalization becomes higher, which means you have more balance sheet capacity, you tend to hold more. And this is just on mortgages, but this is a picture which emerges even when you look across loan categories, as I was telling you. So balance sheet retention seems to be happening at a lower rate than probably the common view might tell you. and it's related to the balance sheet capacity. So you can think about strongly capitalized banks as doing more retention, and less capitalized banks as doing less retention, but doing a lot of selling. What about the other entity, the shadow banks that we have talked about? Well, shadow banks operate very differently. Their business model is quite different. And this is the same market, mortgage market, same time period. And what you see is the retention is very limited. It's mainly selling to GSEs, which is what their business model seems to be. So you're talking about on the spectrum, shadow banks on one side, which are originate to distribute. On the other side is strongly capitalized banks, which are maybe retaining a lot. And then a bunch of banks in the middle, which are doing both a lot of selling and a lot of retention, a little bit of retention. So if you ask whether these things matter for quantity and prices, turns out that if you think about the equilibrium, you can look at this in the data. And here is, for example, prices. One way in which people try to understand how pricing is happening in this market is to look at the so-called jumbo conforming spread. And so on the left-hand side, this spread is being plotted in the 2008 period, which is when banks were not very well capitalized. And now remember, on the jumbo side, it's mainly the banks that are operating because you need balance sheet capacity to operate. On the left-hand side is GSEs, where you don't need as much balance sheet capacity. On the right-hand side of the picture, fast forward to 2014, when banks are substantially better capitalized, what happens there? The conforming jumbo conforming spread drops down because you're able to originate more in the jumbo market. We can see this in the quantities. That's not plotted here, but I can tell you it's the case. And you can see that in the prices getting compressed as well. So where does this leave us? So, it seems that the modern view where shadow banks are pretty important and banks' choice of business model is no longer just holding on the balance sheet, but very actively moving around retention versus selling margin is quite critical. And that's what this whole talk is going to rest on in a substantial way, that we got to rethink the model of intermediation and regulation. You've got to think about competition between shadow banks and banks. Because shadow banks can have a different model, banks have a different model, they are regulated differently, they have different comparative advantages, and we got to understand all that, because in equilibrium, when quantities and prices are going to get affected, you've got to be able to understand all this. So regulation is a little bit more complex than you might think because of all the changes that have happened, but these are substantial changes that we need to think about, and I'll try to argue that if we don't, you're going to get policy expectations on what policies might do pretty dramatically wrong.
Amit, can I ask you a quick question?
Yeah,
please. So it seems like the shadow banking system relies much more on the government sector, the GSEs. So there's much more private-public partnership going on the shadow banking side than compared to the regular banking side. I was just wondering, this is very US focused because the GSEs are very US phenomenon. Would you extrapolate this to other countries as well, or would you say the shadow banks outside of the US have a totally different business model?
I think, it's true that, like, in terms of selling, the US market is GSE centric right now. I think if the private market came back, I don't think that much would change on the shadow banking side, because like we discussed yesterday, for example, before 2006, and Markus, in your work when you explain New Century and other things, that's a pretty similar model, at least on the funding side. So I don't think much would change. And when I look outside the US, lots of economies don't have a selling market. Now, I don't want to extrapolate too much. They also don't have a lot of shadow banking. So, there seems to be some connection between able to get funding from outside, from private market, from well-diversified sources of capital that might be important here. If I think about something like Paytm in India, for example, they used to get funding from private sources, really. And if that's available, you can see that happening, but you need a regular source of capital to be able to do this, because especially an activity like mortgage lending, you got to be able to do this on a pretty regular basis. The turnover is pretty high here.
Would you go so far that the GSEs are propping up in the US the shadow banking system, or supporting it essentially? Without GSEs, there would be very limited shadow banking.
I mean, this is always a tricky issue, right? Like it's definitely true that GSEs are propping up shadow banking system right now. So when people talk about GSE reforms, there is not much discussion on this aspect, because if you take out GSEs suddenly, would the shadow banks be able to stand on their own? It's not immediately clear. We would need a pretty vibrant private market for these folks to survive. I mean, Quicken Loans is mainly it's a pretty big lender. We talked about it, but it's entirely doing GSE lending. You would imagine that if you become big at some point, you might develop a balance sheet and then start doing some jumbo lending. They are slightly doing that a bit now, but not really. It's been mainly GSE. So GSEs have been very critical, is all I can say. If you take them out, I don't know. It'll depend on what kind of private market we come back to.
Thanks.
All right. So at this stage, you might ask that, okay, when we talked about shadow banks versus banks, banks are getting their funding from deposits. Where are shadow banks getting their funding from? We didn't talk much about it. Yeah, they have this originate to distribute model, but what's happening outside that? And we can look at, for example, equity to assets, which was one of the poll questions. And you can focus again on, let's say, in the mortgage sector, where we have a lot of good data. And you can ask the question that, hey, what's the kind of equity to assets that banks have relative to shadow banks? And what's plotted here is just the equity to assets of shadow banks versus banks. And the orange part is the banks, and the darker distribution is the shadow banks. And you can see that shadow banks are dramatically more well capitalized, on average about 25% equity to assets ratio relative to around 11%, which is what I had put in the poll. And if you look at the entire distribution, it's only 0.5% of banks are better capitalized than the mean shadow bank. You might worry that, well, you're comparing banks with shadow banks. Shadow banks do some different kind of activity. Banks do different kind of activities. And in our study, we basically beat the data in as many ways as you can possibly imagine. And what that means is we can restrict this comparison to only banks who are primarily doing originate to distribute, pretty much like, for example, shadow banks themselves. They are only in the mortgage business and they only do originate to distribute like shadow banks. You still see the same kind of distribution differences. We can do this even more if you wanted to say that, well, mortgage is one type of business, but banks do many different types of businesses. If banks are into originate to distribute across different loan categories, that might be a different bank. We can do that and nothing really changes. I mean, I'm just showing you these pictures very quickly because regardless of whichever way you want to cut the data for banks, which is the orange spikes that you see, the distribution is very different from shadow banks. Which is a substantially well-capitalized part of the intermediation sector, which I'll get back to when I talk about some of the regulatory implications. So what have I sort of mentioned so far? I've said that there is a shadow banking sector. There's an interaction between shadow banking and banking. They seem to have different business models, and the competition is, happening differently in different segments. So what we then try to do is to build a quantitative model of financial intermediation. Why do we want to make it quantitative? Because when you think about things like capital requirements, or if I want to change how liquid or illiquid my secondary market is through interventions like QE and so on, we are always wondering about what's the effect on aggregate lending. What's going to be the effect on how much of the risk is going to remain on the balance sheet? What sort of implications might it have across the income distribution? And we can study all that if we build a model like this, which is what we do. So I'll give you a very quick view of what we sort of do here. And the idea is to just give you a flavor of what we are sort of after. What the model is essentially trying to do, big picture, is we are trying to put in these two margins in there. So one is the shadow bank migration margin, which is that you have these entities which have lower regulation. They are in the originate to distribute market, and sometimes, not all the times, because you need the originate to distribute market, sometimes activity might migrate there, and they rely on the originate to distribute market. The other margin we want to introduce is the traditional bank retention margin. What's that? That if you have balance sheet capacity, you will do a little bit of retention, but if you don't, then you're not going to do it. So depending on what your capitalization is, how close or far you are from the capitalization threshold, you might decide to switch between bank balance sheet lending versus originate to distribute, which is always available to a bank as it is to a shadow bank. And then depending on market segmentation with banks and their shifting business model, you are going to get different equilibrium outcomes. So we sort of do that. What we try to do here is build both the demand side and the supply side in a rigorous manner. Some of this has parallels with what I was telling you yesterday, but this is a much richer system because we are interested not just in decomposing the aggregate trends, but we also want to look at things like redistribution across income distribution. So on the demand side, we are going to model consumers through a rich demand system, and the consumers are going to be heterogeneous. They are going to choose a bunch of things, including mortgage size, which tends to be pretty important in the mortgage market. This exercise is again in the mortgage market, but I think it's pretty general. We are able to do this in a much refined and fine manner because we have this kind of data available with us. On the supply side, we are going to be talking about different entities, banks, and then non-fintech shadow banks and fintech shadow banks. Hopefully it's clear from yesterday why these entities might operate differently. The products that are going to be offered will have a price and a non-price component. By non-price, I mean quality, convenience, and so on. That's something that obviously consumers value and turns out to be quite important. If you are a bank, you need to worry about capital requirements, and your financing cost is going to vary with how close or further away you are from the capital requirements. And then just as shadow banks versus banks entities, there is going to be differences driven by just regulation. Shadow banks are regulated and banks are not regulated. Now, this is something that I'm going to come back later, which is that regulation is not just capital requirements. Regulation is beyond capital requirements. So because that has different effects on how banks and shadow banks operate in different markets in terms of supervision and how closely you are worried about things and legal risk and so on. All those things we lump together in the form of regulatory difference, and capital requirements is separate, and both of these things seem to matter quite a bit. So I'll very quickly sort of talk about this, and the details are in the paper, but the reason for skipping this quickly is so that I can talk about a bunch of things that come out of this. So demand side, I already mentioned, there is it depends on the price term, the first term. On the last term is service, which is where we build non-price elements. This is where things like a fintech lender versus a non-fintech lender will be important and will be sorted out based on the data. And then there are things in the middle where preferences of consumers we know are important in a particular market. In this market, for example, size is quite important because there is this conforming jumbo split in the data where a lot of action happens. Consumers sort between these markets. So we got to worry about all of that, and we do. And if you're wondering, what am I talking about? So here is a distribution of loan size on the left-hand side around the same conforming limit. And what you see is that a lumping going on where a bunch of consumers choose smaller conforming loans, and you see some part of the distribution has disappeared from the jumbo side, which tells you that some folks might have a preference for a larger loan, but they decide to switch to a conforming loan because you get some other benefits out there. We want to model that. And what's interesting is if you look on the right-hand side, that these folks who tend to be disappearing, the mass that is disappearing, tend to have different income profile than the income profile of the other distribution at the conforming limit. That's again something that we can use to discipline our model very nicely as we go and estimate it. All right, so in terms of the supply side, very quickly, I told you that there are going to be these three types. Just to reiterate again, traditional banks, because they can sell or keep things on the balance sheet, you need to worry about capital requirements, and the cost is going to vary with that. And they are also going to face the regulatory costs. Shadow banks, because they are in the originate to sell, don't face the same regulatory regime, neither the capital costs nor these other regulatory costs. And the mortgage types that we are modeling here are conforming, which can be securitized or held on the balance sheet, and jumbo, which can be held on the balance sheet. In the extensions, we worry about a different world, not the world we have right now, where maybe securitization happens also in the private market, like Markus was asking. And if that happens, then you can see probably shadow banks entering even on that side of the market, and you can examine what that does to different kind of things in counterfactuals. So
Amit, can you go back to this regression equation? Because there was some interaction term. Could you explain this interaction term? There was an F star and F bar.
So this is just basically telling you that when you think about the utility for the consumer, there might be a preferred loan size that they care about. And if they don't get that, they might get a disutility. And there are two things that we are trying to capture there. One is the lumpiness that happens at that threshold. The other thing that happens is many times consumers, regardless of the lumpiness, just exit the market because they might just say, I don't care about this. I just like one type of mortgage. If I don't get that, I'm out. And so we are trying to capture both of these things here. There are different ways in which you can capture this, of course. Yeah. All right. So in terms of equilibrium, consumers are going to maximize their utility. They're going to worry about the size, like Markus was asking, the type of mortgage they are going to get, the lender they are getting. On the supply side, lenders are going to maximize profits. They're going to choose rates on all mortgages across all markets, and they're going to obviously worry about retention. So I want to just sort of mention very briefly that in addition to the usual ways in which these models are estimated, we have the benefit of a lot of rich data. So like non-standard moments, like I showed you the bunching at the conforming limit and the fact that borrower income at conforming limit is quite different. We are able to use all of that to discipline some of the things in the model. And maybe it's too fast, too quick, but let me give you one sense which is related to the point that Markus was asking, that what is that thing in the middle where consumer utility is getting affected? And those parameters are obviously going to be determined by the data. And so how do we do this? Well, here is one way to sort of think about it. If you think about loan size on the x-axis, and if you see spikes in different markets, that's going to tell you how much disutility you ascribe to not getting the mortgage of the right size. So for example, if you see a desired size and something is missing, you're going to attribute that to disutility. So if you have different markets and you see different types of bunching, if you see a lot of people bunching, that tells you that in that market, people don't care about the disutility of the wrong size. But if you see less bunching, you see high disutility from the wrong size and so on. So you can back all of this out from there. I also want to give you one intuition from the supply side, because that's quite important. And it's going to play a big role when I sort of talk about counterfactuals. So on the x-axis here is capital ratio. And I want to talk about different parts of the market. And on the y-axis is the financing cost. So first thing is that if you are a shadow bank, you're always selling to GSEs. So regardless of the capital ratio, it doesn't affect you. Your financing cost is what it is in the market. If you're a bank, of course, it depends. If you are in the conforming side of the market, which means you can sell to GSEs, you obviously worry about whether you have a comparative advantage on your balance sheet or not. So when you are poorly capitalized, maybe selling to GSEs makes sense. So you are going to shift from retaining on the balance sheet to selling. But when you are appropriately capitalized, you might have a comparative advantage because deposits are cheap and you might be able to sort of do your balance sheet lending. This is not something that you get if you are in the jumbo market, however, because that's always on the balance sheet. So if you ask what is the cost they're going to look like, if you are going to operate in the jumbo market, your cost is going to be higher as you get closer and closer to the capital ratio limit. And some of this cost you can pass to the consumer, which is what makes this pretty interesting and intricate. Because on the jumbo side, if you are the only game in town as a bank and you face no competition, some of these costs you're able to pass on to the consumer, and then it's going to depend on how consumers trade off the elasticity of whatever they're getting charged by the lender.
So Richard Bookbinder would like to know, so the shadow banks don't issue any jumbo loans, or if they issue some, what do they do with that? Sell it off to Wall Street, or they keep it on their books too, or what do they do?
So they have very few jumbo loans, is my understanding. Some of that is changing. Some is changing just because there's a little bit of securitization that has opened up in the jumbo market, but not enough for us to do data analysis yet. Okay. So that's where we are. But again, I think it's not a mystery. If it opens up, that market opens up, you should expect these folks to enter. That's their model. And you will see then banks responding differently. Like I said, right now they have a major monopoly power there. So even though they face higher costs, because if the balance sheet capacity is not there, they might still try to operate in the market because they can easily pass the cost to the borrower. Okay, so what does all this machinery give you, and where does this whole thing about the two margins come in? I think it comes in when you think about different kinds of policies. So let's talk about capital requirements first. And we can start with some baseline and say, What happens when capital ratio changes? How do these things play with each other? And what I want to do is just start with some baseline. And here is an example. So I want you to focus on the picture on the right. And if you look at the baseline, let's first look at what that bar is really. So that's basically plotting for you what the total lending volume is. And different colors are telling you different parts of the market in terms of where the loans are sitting. So here is how you want to sort of think about it. The dark portion is at the bottom is shadow banks, which is all GSEs. So shadow banks are originating that. The blue portion is banks in the conforming market. The dark blue is on the when they sell, and the light is when they're keeping on the balance sheet. So the conforming market is the blue and the dark gray shadow bank portion. What is the red part? Red part is the jumbo, which is all on bank balance sheet. So bank is blue and red and shadow bank is gray. Suppose now you cranked up the capital requirements to 7.5%, which is the graph on the right hand side. Now that's a pretty substantial change in the capital requirement, mind you. Banks and lobbyists of banks fight on even smaller changes, well smaller than this. So what happens? The first thing to notice is if you look at the aggregate lending, it's not changed much. Okay, it's almost the same. You can't visually even tell if the number has changed. So what has happened? Well, when you change the capital requirements, shadow banks, basically there is not much change. What has really changed is not jumbo either on the bank side. What has really changed is bank have just flipped, and instead of doing a lot of balance sheet lending, they are doing a lot of originate to distribute. As it became costly for them to keep the loans on the balance sheet, they have just switched and moved to the GSE model, which is pretty much what shadow banks are doing. You can ask, can we do this exercise on a much finer scale for a much larger range? And yes, we can. And here is what happens if you were interested in lending.
I have a clarification question.
Yeah.
It's an assumption that the total lending volume is not changing, or that's a result of the model?
No, that's the result of the model. So this is all that's being plotted here is the result that the model gives you. So when you crank up the capital requirement, the overall lending is almost the same. Okay, and you can see that in this picture and why that's the case.
Okay, yeah. Yes, thanks.
So what's happening? The first thing is to look at is the dotted blue line, and as you crank up capital requirements, which are on the x-axis, you are going to find that banks are going to retain less and less and less on the balance sheet, which is what the traditional way of thinking about things is. But that's not what determines the aggregate lending in this market anymore. The first thing to worry about is, well, banks have the retention margin versus selling margin. They dramatically increase selling. And that already, if you look at the overall bank balance sheet and what they sell, it looks like they are doing a lot more than if you just focused on what bank balance sheet would look like. But that's not the entire market either. You can ask, what are shadow banks doing? Because some of this activity will migrate to shadow banks. And you find that the red line is what the overall lending is. And you can see around 7.5%, there's a decline, but not much. You need to go really high for the lending to really start getting affected. So that's one sort of learning that comes out of this, that if you want to think about capital requirements and aggregate lending, it's a little bit more complicated than just looking at on bank balance sheet. In fact, the two margins here dampen the overall effect. But that's not how these margins always work. Here is another example. Suppose we did a secondary market intervention, which is we altered purchases such that we influence GSE's financing costs. Once you change that, the effects are quite different. So again, what we can do is a similar kind of picture. The baseline is I'm not doing anything. Again, the starting point is the same. And then suppose I crank up and make it more costly to do the GSE financing, which is the right hand. What do you find? There is a decline, a little bit of decline in the aggregate lending. What has happened? Well, jumbo has not changed much. Shadow bank that used to sell to GSEs have declined a bit. And what has really happened is banks have expanded on their balance sheet because they have a comparative advantage now, even in the conforming market, because shadow banks can't compete as much, whereas they can. So if you look at the same kind of picture where you change the how costly it is to sell to GSEs on the x-axis, what you find is, again, let's look at the dotted line, the bank balance sheet line. So as it becomes more and more expensive to sell to GSEs, of course, bank balance sheet becomes important. Their comparative advantage is higher, so they expand. But if you look at bank balance sheet and what they sell, the overall effect is muted because banks are not selling as much to the GSEs either because it's expensive to sell. Why should they? And if you add on top of that what shadow banks are doing, they are contracting. So what, because that's the only thing they do. If GSE selling is expensive, they got to exit the market. So bank balance sheet retention is changing what happens to the overall lending, and shadow bank is also changing it in a dramatic way. So in this case, instead of dampening the overall shock, they are amplifying the shock in some way. So the two margins have a pretty subtle effect in terms of what happens. So what are the implications that emerge just from this? If you think about the capital requirement increase, like Markus asked, balance sheet lending changed by a lot for banks, but total lending decline was much smaller because both the bank balance business model and the shadow bank migration happened. So you got to worry about this quite a bit. And especially if you worry about total real economic activity, which lots of regulators do. Now, one implication that emerges, which connects to what Markus was asking in the beginning, is if you think about Basel requirements, that's pretty similar across countries. And that works under the assumption that when you change things in a particular way, it affects banks and the banking system exactly the same way. But in some countries, there are secondary markets and shadow banks. And in some countries, there are shadow banks which are not even working the same way that I have sort of argued. You got to incorporate all of that in terms of trying to understand what kind of economic effect that might have. And just assuming that, oh, banks are going to be reacting in a certain way on a balance sheet is a very incomplete picture. So that's one.
Can I ask you? Oh.
Yeah.
So if I think about countercyclical buffers, there's a lot in Basel talk about this. US is not really using it, but if what you're arguing is that in the US it affects it very differently from Europe. In a sense, if I tighten the capital requirements, it just moves to the GSEs, and other countries don't have these GSEs. And James Angel is asking, if you think about an oversimplified model of banks where, the arms are held on the balance sheet and the fixed 30-year mortgages are passed on the GSEs, did you look at the floating versus fixed rate mortgages? Is there any information you can draw out of this? And Laura Allen would like to know, how sensitive is your analysis to the overall interest rate, the base rate, if it rises or not? Are the numbers the same, or is it sensitive to that, or does it matter?
Well, there are lots of questions, but let me try to put them in the same way. So, the model can, of course, generate counterfactuals for changing the base rate and changing a bunch of these things. That's easy to do. We can do it. I forget now what the sensitivity is. I think the biggest changes as far as lending activity is concerned came from altering what you do in the secondary market, which is not surprising because that affects shadow banks in a pretty major way. And that's where a lot of activity is. So that should not be a surprise. On the product side, we have stuck with what we are seeing in the data. It's certainly true that ARMs and FRMs will have very different implications on how some policies are passed, because ARM resets in recessionary times when the rates are low. You could be passing on a lot of benefits of the policy directly to consumers, and that might change who comes in and asks for a mortgage and so on. We haven't done that. Part of the reason is we just don't have that data. And GSEs have released the data, which is what we are using, and their data primarily is FRMs. It's not to say they are not doing ARMs, but for some reason they are not releasing that data. So that's the short answer. So there are limitations there, of course. Now, something that I just mentioned, what I just want to quickly reiterate is that when we think about the policies that are going to affect on the bank side versus secondary market side, these two margins are going to be interacting in different ways. And you got to worry about that. So the implication that emerges from this is that when you think about how the bank balance sheet lending is going to move around over the business cycle, for example, when Markus is saying, that's going to be a function of, okay, how much securitization is happening, how much shadow banking is there, and which segment is happening. So it's a little bit more involved exercise, and something that we are trying to do right now to provide examples. But you can already see from the counterfactuals that you are going to get pretty erroneous inferences if you just ignore all of that. One thing which I didn't talk too much about, but we do discuss some in the paper, is that these policies have very different redistributional effects. So for example, if you, and it all depends on the current industrial organization and the business model that banks and shadow banks are following. So for example, when you do capital requirements and you crank them up, right now, if you did that in the mortgage market, the losers will be wealthy borrowers in high house price areas. Why? Because most of this gets passed on in the jumbo market. So either you are going to take that higher price, or you're going to say, well, I want to now switch to the conforming because what the price I get in jumbo is too high. That means I'm not getting my ideal mortgage, or I might exit the market altogether. And a policy which is different, for example, I might expand the limit at which conforming limit comes in, right? So that's another policy that we look in the paper. And if you did that, then the winners will be across the income distribution. So that's something that we have a lot of debate in the political arena, but not so much in the discussion of regulation. But I think the model lends itself to thinking about that very, very seamlessly. So, okay. So I'm not going to belabor this point. I just sort of summarized this already in what I just mentioned, but I do want to talk about a few other things. So when we think about regulation, obviously, there is also a lot of discussion about evaluating capital requirements. And, are they high? Are they low for the banks and so on? Even leaving aside all the things that I have told you. And what we think is that using shadow bank choices allows you to think about these questions a little bit more. So, you can ask the questions like how much lending is possible with different capitalization. So, questions like, can we do lending without deposits? Can we do lending without branches and so on are now all on the table in some sense. I mean, we have pretty much assumed that these things are required and needed, and maybe they are, but we can start asking the question. So, for example, if you ask the question, how is the capitalization look like out there when you compare banks with shadow banks? So what's being plotted here is equity to assets. The orange line here is banks. There is loan volume, how much activity they do, the size. And the gray line here is the shadow banks. So what is this telling you? First, it's telling you the same thing that I showed you before, that on average, shadow banks are much better capitalized than banks. It's also telling you that capitalization changes with size. For small banks and shadow banks, the wedge is very, very high. For the larger ones, there is a wedge, but much smaller. So, when we think about subsidies and where do the subsidies go to banks, a lot of discussion is on large banks, too big to fail and so on. But if you were to take this literally, what this is telling you is that, look, I could potentially do lending without all of these subsidies, without maybe worrying about deposits, because the shadow banks are able to do a lot of this lending in this market without worrying about keeping such a low equity to asset ratio, which is something we worry about in instability. So, we got to think about this. Again, this is a pattern which is pretty robust across whichever way you want to measure it. And if you want to know that, okay, so suppose we did decide to take these shadow banks as the counterfactual, is this the right thing that we want to consider? Because maybe banks, because they have deposits, provide some liquidity benefits, and shadow banks are not providing, and maybe we value all of that. Maybe banks are a bit more productive and so on. So in our analysis, we build a model where we can sort of evaluate all of these things. And in fact, what turns out in a simple setting is that if you are trying to compare banks to shadow banks, you don't want to take the same size and say that, okay, a bank can easily increase its capital ratio and probably would be still able to lend because shadow banks are doing it. In fact, what ends up happening is because banks have the subsidies, they become larger. And what you then want to do is to compare not the small shadow bank with the similarly small sized bank. You want to compare the small size shadow bank with a slightly larger bank because banks have become larger. And in that sense, the difference that I was estimating when I was looking at this vertically is an underestimate. And in fact, you could probably argue that we could do lending with a pretty high equity to asset ratio. So this is lending without deposits. It's not to say that this is how we should go and do it, but it's certainly on the table. And the size and subsidy view, which is that the subsidies are the largest for large banks, maybe, but here it's pretty clear that the small banks seem to be the ones who are benefiting the most because they are maintaining a thin, razor thin equity buffer and are living off of insured deposits, which are pretty subsidized, and where they could easily ramp up equity to assets ratio like shadow banks. The other point I want to make is that regulatory burden. I've talked a lot about capital requirements. I just did. And but regulatory burden is not just about capital requirement. It operates outside capital constraints in substantive ways. In the model, regardless of whichever way you want to fit the data, if you just relied on banks and shadow banks being different because of capital requirements, you're not going to be able to fit the data. And there are things like this happening in the data. Here is the FHA market. This is a pretty risky part of the market. What have I plotted here is how are shadow banks, non-banks doing versus banks. And in banks, you can look at large banks and other banks. What is worthwhile, regardless of whether you look at purchases, which is the left picture, or the refis, which is the right picture, non-banks have pretty much taken this market. Banks are completely out of this market. You're not going to get this by just looking at, for example, a capital requirement being slightly up or slightly low. You need something more, which is what other kinds of regulations are quite important, like legal risk and so on in this market.
So Amit, can you explain what FHA market is for people outside of the US?
Yeah, so this is again a subsidized market. Thanks, Markus, for pointing that out. And this market is subsidized in the following way, that the requirement for the loan to value ratio, which is how much down payment you need to do, is very minimal here. So if we are talking about 98% is debt and 2% is equity. So it's a very thin market. So you can imagine slight movements in house prices or your economic condition will lead to a lot of defaults, which did happen every time there's a recession. And when that happens, there are a lot of lawsuits. And because the lawsuits and the legal risk became pretty high in terms of government pursuing them in this period, banks have decided to exit this. And non-banks are still okay in this space because I guess they are not as.
What does FHA stand for?
Federal. Good question. I'll have to Google this.
Fine. We know what it is now.
Okay, you do? All right. Okay, so the other point that I want to mention is that so far I've mentioned about the banks and shadow banks and how that affects lending and different policies and how that might get affected. There was a question earlier about the rates. So one interesting thing, if you connect what I showed you yesterday to today, is a lot of fintechs are in refi sector. You can imagine if they are so heavily into refi, that's going to be a function of what kind of monetary policy is being set right now. So if that changes, then the way they operate is going to change. And if that changes, that affects how the aggregate lending and other things that I was showing you evolve in the economy. So that's certainly an important angle to think about, that transmission of policies to lending and so on is affected by what I showed you. Another thing where this plays a big role is distress. Now, distress is something we don't talk about too much. We did talk about it quite a bit after 2007 because we faced the Great Recession and a huge foreclosure crisis. But we had to think about it very recently with COVID because there was a lot of forbearance. When there is a lot of forbearance in the household sector, who is going to be providing this forbearance? And the forbearance is not just provided by banks. This is not the old traditional model where banks are originating the loans and keeping them. They screen, they monitor. Now shadow banks are doing the so-called servicing. Servicing is like monitoring. You try to figure out whether the borrower will pay. If they pay, you channel the checks between different parties that own the risk and originate the risk. And otherwise, if they are distressed, you end up doing a lot of restructuring. So what's being plotted here is how much activity in this market is done by shadow banks. And again, not a surprise, a huge amount of activity is being done by shadow banks. And does this really matter? One can actually look at this. If you look at the CARES forbearance mandate that was just happened in the US and is still under play, it's a very simple debt relief program. One lesson from the Great Recession is if your debt relief programs are a little bit involved, like the HAMP program was or the HARP program was, those full forms I know, Markus, I haven't forgotten those. But if you look at those programs, they were a little bit complicated, and that led to debt relief programs not getting transmitted as much as we might have desired. The CARES mandate was a pretty simple program. If you are a mortgage that is insured by the government, so all conforming mortgages, you don't need to submit any paper, nothing. The borrower just needs to request for forbearance. So you might think that, how will it matter whether you're a bank or a shadow bank? And turns out it does matter. So if you look at forbearance being provided by banks and shadow banks, there's a big wedge. The dark line here is by the bank, and the other line is the shadow bank. And there's a big wedge in terms of how much forbearance shadow banks are providing, even though this is a pretty standard, straightforward program. And it has to do with the fact that they did not have a lot of balance sheet capacity, by the way, which we can get to if you're interested. But the point here is that the regulation and how intermediaries transmit the policies to the real economy is not just through lending, it's also in distress times. We should not forget that these folks are also heavily involved on that side of the value chain that banks bring on the table as well. So it's not just screening, it's also monitoring and restructuring.
But if I go back to this chart, I mean, there's already a gap before the COVID crisis now.
Yes.
And then it just seems like the gap is just staying there. Or
yeah.
How would you interpret that?
I think the gap before, forbearance is what it is. I mean, shadow banks, they have a balance sheet capacity constraint, typically because shadow banks are selling to GSEs. The contract with the investors work in the following way. GSEs, for those outside the US, they take the mortgages, pool them, and sell it to investors, and they insure the default risk. So what they're telling the investors is, hey, if the payments are short, don't worry, we'll take care of it. And by saying we, they tell the servicer to take care of it. And the contract is, while you work it out with the borrower, you got to keep making the payments. And then once you've figured out whether you can get the mortgage back on track or you foreclose, those charges will be given to you through our contract. But in that time, you got to make that payment. And, not surprisingly, shadow banks don't have a big balance sheet capacity, so they might be reluctant to do a lot of these things. And a lot of the wedge that you see had to do with that. And the GSEs had to clarify and provide them lines of credit and so on to get them functioning. But point is, we completely missed this because didn't think about this.
So Roger Stein would like to know, in general, given the dependence of shadow banks on liquidity, on refi and syndicated refinancing and origination and distribute model, what are the implications for systemic risk? Have you thought about this to the systemic risk component? What the interaction spillovers from the shadow banking to the regular banking, vice versa, and things like that, or within the shadow banking system?
I mean, we haven't gone to the systemic risk because there is one other element which is quite important here, which Erica models in her job market paper, which is if you look at shadow banks have a lot of equity. I showed you that. But if you ask, what about the debt? They still have debt. Where is that coming from? It's not coming from deposits, and it's not coming from commercial paper. It's actually coming from banks. It's coming from very few banks. It's coming from 3-4 banks on average. So now you have an intertwined system where funding is coming from banking system, which is subsidized through deposits, and the selling is happening to government-sponsored entities who are also implicitly on taxpayer balance sheet. So it's a pretty complicated system, but fair to say the government has a big role to play on both sides here in indirect ways. So if you really want to go systemic way, you will have to put all of these things together. We haven't gone there yet, but we are hoping at some point to get there. Okay. So I want to, like yesterday, because this is also catered towards the PhD students, talk about a few open questions and see where we might end with that. So the first thing is, I've already mentioned this, we get to the heart of what do banks really do? So can we do banking without deposits? If we can, what kind of activities can we do? Is it lending? Is it payments? Is it both? And this gets to the whole idea of there is going to be a lot of bundling and unbundling of different services. This is something that Markus has talked about in his work as well. And as people talk about, okay, there's going to be competition from central bank digital currencies on the payment side. And if that happens, then the deposits are going to get crowded out. But if deposits we think are crucial to lending, then that will have an effect on lending. So it becomes a pretty complicated exercise. At the same time, it's pretty exciting because what do banks do? It's high time we've got an answer to that. And on the same point, you are also like puzzled on what their business model really is when it comes to lending. There are some loans they sell while others they keep on the balance sheet, not just in mortgages, but if you think about corporate loans, there are some type of corporate loans they are happy to sell, other type of corporate loans they are keeping. Why is that happening? I don't think as academics we have spent too much time thinking about this. And given how important this margin is, as I try to emphasize, I think it's something that we want to understand. One other open question, which I didn't have much time to sort of talk about, is that if you look at the bank leverage, it looked pretty flat across the size distribution, right? Like 10, 11% didn't seem to matter. But that's both insured and uninsured together. If you think about various theories of capital structure, they are mainly about the part of the debt which internalizes some default in some way. So what you really want to focus, if you want to think about banks, is to think about uninsured part of the leverage. When it comes to shadow banks, everything is uninsured, so we can just directly look at that. And when you start doing that, you see very consistent patterns in intermediation when it comes on the perspective of uninsured leverage with size. So what do I mean by that? Here is the picture, that same flat picture that I showed you of banks. If you decomposed it, and this is just looking at banks across the size distribution, and if you looked at uninsured and insured separately, what do you see? Well, you see as the size becomes larger, uninsured becomes more, and insured drops. Together, they look like a flat line. So if you were to only look at the uninsured part of the debt and plot now shadow banks and banks, what do you see? Very similar pattern. The uninsured leverage increases with size for both shadow banks and banks. And this is quantities. You can look at interest rates as well. If you look at prices, left is shadow banks, uninsured debt price falls with size. And on the right-hand side, again, the dotted line at the top is uninsured for banks, and that also falls with size. So there is something about uninsured debt increasing with size and becoming cheaper, which we would like to understand, and we don't yet. The other question is, I have told you migration is happening to shadow banks. There is retention on banks' balance sheet. There is an IO, there is an equilibrium. Markus and others want to also think about systemic risk because there is intertwined things happening here. And the question is, can we fine tune this as much as we would like to? Maybe the answer is just higher equity because that seems simpler. Maybe not, but that's again an open question. Hopefully enough PhD students will be interested in that. So let me conclude here. So the point that we are trying to make here through a collection of work is that the views based on bank balance sheet are very incomplete. This is not how the modern financial system is. There's a lot of activity outside the banks, and banks themselves are not relying on balance sheet. They actively morph between retention and selling. And if you want to sort of think about this as what some people do, which is like, hey, okay, fine, there is some activity outside the bank. All we need to do is to stick with what we have and just scale up whatever we thought banks are doing, and scale it up by whatever activity went outside. There are certainly some folks out there who think like that all we need to do is, okay, we have bank activity, just scale it up by a factor and we'll get the entire picture. And that's pretty far from the truth. Hopefully I've convinced you because of industrial organization, business model, and the equilibrium. And lastly, hopefully I don't have to again reemphasize that we do care about all of this because regulation cares about lending, real economic activity, stability, redistribution. All of those are intertwined here. And as academics, the economics of what banks do is all central here, and hopefully we are going to get towards answering that. And I think I covered most of the poll questions. And like yesterday, 2 of the poll questions were not answered appropriately by the audience, and 1 was, but that happens. That's why we do research.
Thanks a lot, Amit. So there are a lot of open questions, and I really find this a very valuable ending as well, because it really helps many PhD students who are searching for topics to get into that. But there's one elephant in the room, and we touched on that, which is the GSE reform, which you said essentially after your talk and listening to your talk, that's even more important and more problematic than we thought before. And it's not only how should we design the system after the GSE reform, that's one big challenge. Perhaps you have some thoughts on that. But what's about the transition phase? How do we get there if we have an optimal designed system afterwards? And would you recommend other countries to establish something like GSEs, like, you know, go to India, Europe, or anywhere, say this GSE thing is actually a good thing. It stabilizes because I can crank up the capital requirements for the banks without really ruining the lending market. What's your thoughts on that?
Marcus, I wish I could reform the GSEs in the next 30 seconds, but I'll try. So I think, you know, GSEs over the last decade or so have tried to move away from their usual business model because they've tried to now get some private market participation through the risk program that they have, where they sell the lowest tranche without guaranteeing it for default in the private market. But I think it's still a pretty substantial part of what they do is buying conforming mortgages and selling it to investors with the default insurance. How do we get them out of the market? Should we get them out of the market? Certainly seems like we should have competition in that part of the market. Securitization, which is what they're doing, is not that complicated. I mean, we figured it out for a long time. But at the same time, when we tried to do it a bit too fast, too quick, the last time, I think there were lots of deficiencies in the private market. And one of the reasons why it's not coming back, at least that's my view, that Akralov's theory at some point kicked in and, you know, market broke down and it hasn't come back yet. But it seems like going to a market where GSEs would not be so dominant would be reasonable. If you think about markets where some shadow bank is out there. So for example, in India right now, you know, shadow banks are doing a lot of activity. They are also regulated by the central bank though. So the central bank has some color on what they are doing. At the same time, a lot of shadow banks also get funding from banks itself, and in particular, the state banks. So they may not call these things GSEs, but it's government-sponsored money that is floating into a lot of these shadow banking. So if we can get the shadow banking, and you know, shadow banking is a strange name, let's call it non-banks, and we can get private money flowing in this market, I think it would be a great win-win for everyone. And like you said, we would like to crank up the equity requirements for banks, not worrying about lending. Maybe there are other things that we need to worry about, by the way. I don't know. Maybe there are liquidity benefits that deposits provide, which somehow only banks can provide. All of those stories are out there, but I think there's more research needed for that. That would be my view.
So let's end with one thought I would like to get from you is, you know, if you have all these fintech companies eroding the deposit base of banks, their balance sheets will be not so strong anymore in a sense, or their cheap funding opportunities will not be there. And we allow for other neobanks and other settings competing for deposits. How do you see that interacting? Would you see that playing a major role, as big a role as the GSE play on the refinancing side?
I do. I think that's where payment companies, PayPal, Venmo, when they are taking away deposits. I mean, PayPal right now is even though it's not a bank, it has the deposits that it has is like makes us the 20th largest bank. And they are going to be eating into deposits. They are providing a lot of services. They are reaching to consumers in great ways. And I see banks as either they have to, compete, which is what Goldman Sachs with the other Markus is trying to do. Because if you look at the younger generation, they are not used to going in a branch. They are not used to talking to a person. They are happy to just do their activity on a phone. So for them, Amazon and Apple is more reliable than Goldman or JP Morgan. So banks are going to face more and more pressure. And I think typically if our research is a guide, we know that when banks are pushed and franchise value goes down, they tend to take a lot of risk. So we got to be pretty careful in not going that route. If banks want to compete by also adopting the technology and trying to come up with different ways to do this, great. But if the way they compete is by taking risk, I think that's not a great solution for anyone. But I'm optimistic. I think we are going to be in a great place. Banks needed to be disrupted. I think our colleague Thomas Philippon would agree in the US. So I think we should give it a shot.
Great. Thanks a lot, Amit. Like yesterday, you still have a chance to make a positive ending note if you want. Otherwise, we go with yesterday's ending note. I'm just very grateful for your excellent presentations and lots of insights and knowledge you presented to all of us.
Thanks, Markus. Thanks for the invitation. Yeah, my ending thought is just like for PhD students again, that try to figure out what banks do. You would think that we know, but we don't. This is a great area to work on. And for the society, I think exciting things ahead. So keep watching this space.
Very good. So have a nice weekend. Enjoy your time and see you hopefully in the real world pretty soon again.
Thank you, Markus.
Thanks, Amit. Bye-bye.